Jose Ricardo Tejan, Market Search Daily. Today I want to talk to you about a 3,300 pip opportunity to the upside in the currency cross Euro versus New Zealand dollar. First, I'm going to explain the key historical level that you must be watching. Second, the key Fibonacci structure required to be in place to take any trade. And third, how you can do the same, step by step. Now, let's go to the charts and make it happen. Currency cross, Euro versus New Zealand dollar. We're going to take a look at the historical level. First, we're going to see here, we go all the way back to 2005. The low has been in place at 163. We have it here, 163.34. Eventually it turned to be a resistance. But there's more value when you have plus 12 years of historical data. The markets have memory, so what they did in the past they will eventually of course do it in the now and in the future. Here I'm also using Fibonacci expansion, considering that in the short term, medium term, we already have a bottom here. Let me show you. This will be 162.85, so all the way the upside, the 61.8% will be at 183.70. If I take it from this point, and this is the bottom, in fact, we're looking at 1,800 pips. Nevertheless, I mentioned to you at the beginning of the video, we're looking at 3,300 pips. The most important to consider is the range. We are in a set that prices are opening and closing above the historical level, plus 12 years, 163.34. Therefore, the smart money, assuming smart money is telling us that they don't want this currency cross to trade below this range. We're talking about almost plus 170 pips. So if we take 1, 2, 3, 4, 5, that's 5 months the markets have been rejecting prices lower than 165. If we finally have an open and close above 166.50, I will be even more confident that there is a massive change in this currency cross and will exactly going all the way back to trade at 180. Of course, I'm going to take a look at the Fibonacci structure. This is the way it looks. I will explain step by step how you can do the same. First, we're looking more information. We need to have as much information available. We have the 50 exponential moving average on the monthly. This is showing me as well there's massive support, and the key Fibonacci structure is the 50%. We are at 162.20. Market went all the way to 162.85, and the 12 years, more than 12 years historical data indicates 163.34. This is very important to understand. So once you have that, you want to take the full Fibonacci projection from the low to the high, and then take it from the position where it's reversing, or at least we think it's reversing. So in this case, we do believe it's reversing from the 50%. So going all the way, it takes prices all the way to 195. Couple fundamental views to take here. First, sentiment is all the way shorting, extremely bearish the euro, and on the other hand, the New Zealand, via the Reserve Bank of New Zealand, has been not as dovish as expected as the Reserve Bank of Australia. What that tells me is now we finally have this shift, we can see how the rhetoric, the narrative from the central banks can change, and as Nordea markets, for example, Danish investment bank is concerned that no central bank will be in position to raise interest rates for the foreseeable future, then a surprise on the euro is more likely to take place and push this cross higher. Now, of course, we have in this section, if we look to the left, we have this big candlestick, the tail, and this is telling us that a lot of buyers were trapped here, and the market shifted on them and went all the way short. It means that these traders will be happy if these prices go all the way push forward, and they can actually get out of these positions, break even, or at a small profit. So considering all things equals, we will actually position ourselves to go for this, and easily we can be looking at, as I mentioned at the beginning of this video, plus 3,000, between 3,000 and 3,300 pips. Now, let's go to the step-by-step how you can do the same. First, I'm just going to remove this once again, step-by-step. You go into the monthly chart looking for key opportunities. The first step, I'm going to drop my moving average, 50 exponential. One more time, I'm going to just show you how you can do the same. Always make sure you set a direction in the market. Where are you going? You're going bullish or you're going bearish. So in this case, 50 exponential and from the typical price, you go HLC, high, low, close divided by 3. And I'm going to use a blue color. Now, as you can see, when prices are up, we have plenty room to go all the way to this area. So if prices keep pushing, I have no doubts that we're going to fill the void in a V recovery to 179. Also, keep in mind that when prices are trading above the exponential moving average, you're looking for buy. You favor buys. That's the most important. And then the second step is that I will take this Fibonacci from the low to the high and see exactly where I'm trading. Right now we're trading on the halfway of that retracement, the 50%. So as long as don't have a close and open below this, I'm bullish, and I will be adding positions to target initially the V recovery all the way to the 179. And finally, the way you see the massive projection, how much you have in place, I'm just gonna delete this one more time, do the projection, take it here, and you're just gonna have the extension. I'm gonna put it from what I do expect to be the reversal, and once again extend this portion of the area so I have my measure. Now with this projection, I exactly know where it's gonna stop. As part of your money management, risk management, you will have opportunities to start closing small positions. So from this area here, we'll be looking for the V correction. That will be 1,600 pips, eventually 2,300 pips, and the final target 3,200 pips. I get a lot of the question, how long it's going to take? Now, we can have some sort of mathematical idea in how this is going to happen. We're going to go back in time. Let's just take a look. They're straight the last couple years. Let me see, I'll move here this. So for example, when the market starts, the euro starts moving high, it's 1, 2, 3, 4, 5 months. It took 5 months for it to make a push close to 4,300 pips. This rally as well here from another bottoming place. 1, 2, 3, 4, 5. This is the pullback. 6, 7, 8, 9, 10. 10 months of continuing upside, 2,700 pips. In 2 months, for example, here, 2 bullish months, 1,300 pips. Here we have a combination as well, 1, 2, 3, 4, 5. 5 months, and it took about 2,000 pips. So give and take, I'm looking at this position here, and I will say it will take about 3 to 6 months to really unfold in favor of the euro dollar. So this is exactly what I'm looking. You have seen so far. I'm gonna just leave you with this, the last Fibonacci expansion here. This will be so far in the short term. For short-term traders, my risk will be at the low of the month. So far, the low of the month of March, that will be 160.85. And you know how I'm expecting to take out of this currency cross 3,300 pips to the upside. There you go, guys. What a great opportunity to position yourself into the 3,300 pips long euro versus New Zealand dollar. Key takeaways. First, remember this historical data. This is 12 years of data there. 163.34. That's your key support. And we are right there. The low this month so far in March was 162.85. Now, the Fibonacci structure. Always remember to know where are you? Where are prices trading there into the Fibonacci? And finally, where is the market now? The market is extremely bearish euros and slightly long New Zealand dollar. So anything that shifts here will favor the euro because it has been extremely oversold. So that's the perfect opportunity to squeeze those shorts and then push to the upside. So there you go. Now you have it. You know exactly how you can profit from this trading scenario. Please make sure you subscribe to this channel. Come back to our blog. We'll have ton of quality, actionable content for you to take a look, think, and execute. Here are Market Traders Daily.